Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Yeah, and there is absolutely a lot happening out there right now.
Oh, totally. It's early April 2026, and if you're just looking at the everyday news, it feels a bit chaotic.
Right, just a bit.
The Trump administration is navigating some incredibly high geopolitical tensions all over the globe.
Hmm.
And if you're like most Americans, the biggest headline you're seeing every day is this terrifying resurgence of inflation. It's just front and center.
It's all anyone is talking about, really.
Exactly. But for this deep dive, we're looking at some recent analysis that shows a massive fundamental shift happening just beneath that surface panic.
Yeah, a complete rewriting of the global market playbook, basically.
Right. The world's biggest investors are actively moving their money away from traditional Western safe havens. And today, we are going to explore exactly how and why this whole new financial ecosystem is being built.
And I just want to emphasize, the scope of this capital migration is, it's truly historic.
Really is.
We're looking at two distinct structural shifts happening simultaneously in China's financial ecosystem.
Okay, so what are the two shifts?
Well, on one front, you have Hong Kong aggressively reestablishing itself as the premier hub for global stocks.
Right, the equity side.
Exactly. And on the other front, which is honestly much more surprising, institutional investors are using Chinese government bonds to shield themselves from Western inflation shocks.
Okay, wait, I want to unpack both of those, but let's start with the stock market side first.
Sounds good.
Because, for companies looking to issue shares and raise cash, Wall Street has historically been the absolute pinnacle, right?
Oh, absolutely. The gold standard.
Like if you were a big international tech firm, you rang that bell in New York, and boom, you had access to the deepest pool of capital on Earth.
That was the dream for decades.
But looking at the recent data, that pipeline has basically completely rerouted.
It's a massive detour.
Yeah. Like Hong Kong actually took the crown as the #1 global IPO market back in 2025.
Right. They raised roughly $37 billion.
$37 billion. That's across, what, like 119 different listings?
Yeah, something like that. And the momentum heading into the first quarter of 2026 here is just staggering.
It really is. What's the latest snapshot on that?
Well, just to give you an idea, on March 20th alone, 5 major Chinese companies initiated pushes for IPOs in Hong Kong.
5 in one day.
Yeah. Targeting nearly $678 million just between those 5.
Wow.
And this is really the culmination of a trend that accelerated late last year. You had heavily backed firms like Momenta.
Oh, the autonomous driving company, right?
Exactly. They completely abandoned their plans for a New York listing
Yeah.
and just pivoted directly to Hong Kong. Wall Street it's just no longer the default destination.
I kind of get the hesitation, right? With the current U.S.-China trade tensions under the Trump administration, things are heated.
Very heat.
But giving up access to U.S. capital seems like a huge sacrifice for a growing tech company.
Well, you would think so, yeah.
Like, for you listening, imagine your business is located in the most prestigious, busiest shopping mall in town. That's Wall Street.
I like that analogy.
Thanks. But the landlord keeps changing the rules, and it's pretty clear they don't really want you there because of all this geopolitical friction.
Right, the regulatory threats.
So you move your flagship store to a mall closer to home, which is Hong Kong, where you actually get VIP treatment.
Exactly.
But my question is, are they permanently leaving the big mall? Or is this just a temporary detour until Washington and Beijing cool off?
Well, see, it would be a sacrifice if they were actually losing access to the big mall's customers. But they aren't.
Wait, really?
Yeah. The reality of the Hong Kong market is that it offers this really unique dual advantage. Experts are calling it the dualization of their capital.
Dualization. Okay, break that down for me.
So this isn't just about avoiding a geopolitical premium or the severe regulatory risks of being listed in the U.S. right now, right? By setting up in Hong Kong, these companies can tap into vast reserves of Chinese domestic wealth.
Okay, the local money.
Right. But simultaneously, they can still raise U.S. dollars from international institutional investors who operate freely in Hong Kong.
Ah, so they still get the international shoppers, just without the constant threat of a sudden regulatory shutdown from Washington.
Exactly. They aren't retreating into a closed system at all. They're literally just changing the venue where the transaction happens.
That makes so much sense. And honestly, the sheer amount of physical money following this move is wild to me.
The real estate data is crazy.
It is. When you look at the recent commercial real estate numbers, you see JD.com dropping like $450 million for half of the Central Tower in Hong Kong.
And Alibaba, too.
Yeah, Alibaba bought 13 floors in Causeway Bay for $925 million. That's almost $1 billion on office space.
And that right there is your answer to whether this is temporary. Those physical acquisitions are concrete proof that this is a permanent structural shift.
Because you don't spend $1 billion on an office if you're planning to leave in a year.
Exactly. You do not sink that kind of cash into prime real estate in one of the most expensive cities on Earth unless you are building long-term infrastructure.
Right.
We are seeing a massive physical relocation of prime brokerage services, investment bankers, and legal teams back to the core of Hong Kong.
You know, the legal teams part is actually crucial here.
Oh, absolutely.
Because you don't buy dozens of floors in a premium skyscraper just to house more stockbrokers. You need that space for the lawyers and the compliance officers.
Yep, the paperwork is piling up.
According to the data, firms like CTEC, CLSA, and Guotai Junan International are aggressively expanding their legal departments in Hong Kong right now.
And that expansion is a direct response to a very new operational reality.
Meaning what exactly?
Meaning Beijing is actively engineering this financial ecosystem. They recently initiated several high-profile insider trading probes.
Oh, wow. So they're cracking down.
Big time. They are establishing an incredibly rigid framework. This is not some free market free-for-all where any startup with a good pitch deck can just roll in and raise billions.
I want to dig into that framework, actually, because one of those fascinating things I saw from regulators in mid-March involved these so-called red chip companies.
Yeah, the re-domiciling rule.
Right. The rule dictates that companies with complex overseas structures have to legally re-domicile, basically move their legal headquarters back to the mainland before they're allowed to go public in Hong Kong.
Yes.
But what is the actual mechanism at play there? How does just changing a corporate mailing address change the financial reality of the company?
It's all about capital control. Historically, a lot of Chinese tech companies use these offshore structures, right? Registering in places like the Cayman Islands.
Sure, you hear about the Cayman Islands all the time.
Right, and they did that because it allowed them to raise foreign capital and move money around while entirely bypassing the strict foreign exchange controls of the Chinese mainland.
Oh, so it was a loophole.
Exactly. So by forcing these red chips to legally re-register their primary domicile back in mainland China prior to their IPO.
Beijing basically closes the loophole.
Yes. Beijing legally subjects them to domestic transparency laws. The government gains absolute visibility into their accounting and, most importantly, ultimate control over their foreign exchange reserves.
Man, that paints a very different picture of this whole market boom.
It's very controlled.
Yeah, it feels a bit like an incredibly exclusive high-end nightclub. Like the line to get in is wrapped completely around the block.
Over 530 companies are currently waiting in that IPO pipeline.
Right, so the demand is there. But the bouncer at the door isn't just checking to see if you have enough cash to buy a table.
No, the bouncer is auditing your entire corporate tax structure to ensure Beijing holds the ultimate veto power over your operations.
That is a thick filter.
Very thick. Regulators are systematically prioritizing listings for companies in strategic sectors like artificial intelligence and advanced manufacturing.
And I'm guessing they're blocking the ones they don't like.
Heavily scrutinizing or outright blocking them, yeah.
But here's the thing. Even if you make it past that strict bouncer and you get inside the club, you aren't immune to the weather outside, right?
Not at all.
We saw exactly what happened on March 9th when the Middle East war escalated. Global macro shocks still rip right through this market.
Oh, they hammered the new listings.
Totally. Alsco pooling service dropped 44% on its very first day of trading.
Brutal.
Eston automation fell 16%. That is a rough opening day.
And that volatility is a really vital piece of the puzzle here. The Hong Kong equity market is absorbing massive amounts of capital, but equities, by their very nature, are risk assets.
Right, stocks go up and down.
Exactly. So when a massive geopolitical shock like a war in the Middle East occurs, all that capital in Hong Kong is still extremely vulnerable to severe drawdowns.
Which perfectly brings us to the most perplexing part of the data we're looking at today.
The bond market.
Yes. If billions of dollars are flowing into the Chinese financial ecosystem, but the stock markets there are still volatile enough to wipe out nearly half of a company's value on opening day. Where are institutional investors parking the money they absolutely cannot afford to lose?
Well, to find that safe capital, we have to transition away from the stock market entirely. We have to look at the sovereign bond market.
Okay.
And this is where the global market playbook has been just entirely rewritten.
See, I want to push back on this before we even dive in.
Go for it.
Because the standard playbook for an American asset manager facing a global crisis is practically written in stone.
Right, the flight to safety.
Exactly. When a war breaks out, or when a massive energy shock threatens to spike inflation, you sell your volatile tech stocks and you buy United States Treasury bonds.
That's been the rule forever.
U.S. debt is supposed to be the foundational bedrock of global financial safety. Always.
And it was the indisputable reality for decades. But the market data from late March 2026 tells a completely different story.
Yeah.
Well, the escalation of the Middle East war triggered a massive global energy shock. And those traditional Western safe havens, they went into an absolute tailspin.
Really? Even U.S. Treasuries?
Yes. We saw the yield on the U.S. two-year Treasury spike by 45 basis points. The 10-year yield jumped about 40 basis points.
Wow.
And it wasn't just an isolated American phenomenon either. European and Japanese sovereign bonds suffered identical heavy sell-offs.
Okay, let's quickly ground that bond math for a second, because I know the terminology can easily trip people up.
Yeah, yields and prices can be confusing.
Right. When we talk about bond yields spiking, we're actually talking about the asset losing value. It basically operates exactly like a seesaw.
That's a great way to put it.
If investors panic and start dumping their U.S. Treasuries, the price of that bond plummets.
Mm-hmm.
And because the price drops, the fixed interest rate it pays out suddenly represents a higher percentage of that new lower price.
Right, the yield goes up.
So a spiking yield is basically a blaring fire alarm that the asset is hemorrhaging value.
That seesaw dynamic is essential to understand, because in late March, global portfolio managers grabbed their standard fire extinguishers, U.S. and European government bonds.
And they found out the fire extinguishers were also on fire.
Exactly. The assets they relied on for safety were losing value precisely when they needed them most.
Why?
Because Western economies are incredibly vulnerable to energy-driven inflation.
But the data shows that Chinese government bonds didn't catch fire at all.
Nope. Not even a little bit.
During that exact same global panic, the Chinese two-year yield actually dropped by 11 basis points. So the seesaw tipped the other way. The value of Chinese debt actually went up.
It became the true safe haven.
But hold on. You are telling me that highly sophisticated Western institutional investors are buying billions in Chinese government debt to avoid risk.
That's exactly what the data shows.
In the current geopolitical climate, with all the friction between Washington and Beijing under Trump right now, tying up massive amounts of capital in a system managed by the Chinese Communist Party sounds like the literal definition of a high-risk gamble.
I know, it sounds totally counterintuitive, but you have to separate the geopolitical risk from the immediate macroeconomic risk that these investors are trying to hedge against.
Okay, explain that.
In late March, the primary threat destroying portfolios wasn't a potential future geopolitical sanction. It was immediate, crippling energy inflation.
Right, oil prices shooting through the roof.
Exactly. And China has spent years building specific structural insulation against that exact type of shock.
Well, what kind of insulation allows an economy that size to just shrug off a Middle East energy crisis?
It comes down to three physical supply chain realities. First, China has been aggressively hoarding strategic oil reserves while prices were relatively lower over the past few years.
Okay, so they have a big stockpile.
Right. Second, their domestic adoption of electric vehicles vastly outpaces the West.
Oh, interesting. So everyday consumers aren't buying as much gas.
Exactly. It significantly reduces the daily consumer demand for refined gasoline. And third, they have fundamentally re-engineered their energy import reliance.
How so?
Just look at PetroChina's recent disclosures. They noted that only 10% of their oil and gas supply relies directly on the Strait of Hormuz.
Wait, only 10% reliance on Hormuz? That is a staggering statistic.
It's massive.
Because, for context, for you listening, that strait is the ultimate global choke point for energy. Like, when conflict erupts in the Middle East, Washington and Brussels panic because their economies are so deeply tethered to that specific shipping lane.
They're entirely dependent on it.
But Beijing just, taps its diversified pipelines from Russia and Central Asia, leans on its huge domestic EV fleet, and just keeps the lights on.
Basically, yes, the insulation is formidable, though, we should maintain perspective here.
Right, they aren't magic.
No, China is not entirely immune to global commodity pricing. Even with their diversified supply, their manufacturing input prices. So the cost for a factory to purchase raw materials, that index did jump from 54.8 to 63.9 in March.
Okay, so they definitely felt some inflationary pressure.
They did, but relative to the devastating blow taken by Western markets, the Chinese bond market absorbed the shock with incredible resilience.
But see, insulation against an energy shock doesn't fully explain this massive capital inflow for me.
What do you mean?
Well, just because a country has a lot of electric vehicles and alternative pipelines doesn't mean you automatically buy billions of dollars of their sovereign debt, right? There has to be an underlying economic engine driving this dynamic.
Okay, yeah. You have hit on the core paradox of this entire
My
situation.
paradox.
Yes, the underlying economic engine driving the strength of Chinese bonds right now is actually the severe structural weakness of the Chinese domestic economy.
Wait, what? Explain the mechanics of that because that sounds completely backward. Strong bonds because of a weak economy.
It does sound backward, but on March 31st, the People's Bank of China, their central bank, right?
Right, the PBOC.
They officially confirmed they would maintain an appropriately accommodative monetary policy.
Which means what in plain English?
In practical terms, that means they are deliberately keeping interest rates low and injecting liquidity to keep borrowing cheap.
Which is the exact opposite of what the Federal Reserve and the European Central Bank have been doing. The West has been battling inflation with punishingly high interest rates.
Exactly.
So how does the PBOC have the luxury of keeping money cheap during a global crisis?
Because China is suffering from a huge imbalance. They have massive manufacturing supply, but historically weak domestic demand.
So people aren't buying things.
Right. The Chinese consumer is aggressively saving, not spending. Property sector woes and employment anxieties have basically frozen domestic consumption.
Okay, I see where this is going.
Because nobody is buying goods domestically, there is virtually no demand-driven inflation inside China. Combine that low inflation with data from April showing the Chinese yuan remaining highly stable against other currencies.
And you have a perfect environment for sovereign bonds to thrive.
Exactly.
Because if you are an American or European portfolio manager and you're staring down the barrel of stagflation, where your own domestic prices are surging but your economic growth is stalling out.
It's a nightmare scenario for them.
Right, so suddenly this Chinese macroeconomic environment looks incredibly appealing as a hiding spot.
Precisely. When institutional capital flows into Chinese bonds right now, it is not a speculative bet that the Chinese economy is about to experience this massive, roaring boom.
It's a defense mechanism.
Yes, it is a calculated macroeconomic hedge. The weak domestic economy forces their central bank to keep yields low and prices stable, and that inadvertently creates a perfect storm shelter for foreign capital running away from Western inflation.
I love that. So basically, the traditional safe havens like U.S. Treasuries are acting like high-performance sports cars.
Okay, I like where you're going with this.
Normally, they are great, right?
Yeah.
Fast, reliable, in good weather. But the moment they hit a massive pothole, like a sudden energy shock or a supply chain crisis, they blow a tire and spin out into the ditch.
Exactly. They can't handle the rough terrain.
But Chinese bonds, right now, are operating like a slow, heavy, incredibly boring minivan.
A highly controlled, reliable minivan driving on a closed track meticulously managed by the central bank.
Yes.
It won't win any drag races in a booming global bull market, but when the global economy hits that massive inflation pothole, the minivan's heavy suspension absorbs the shock completely, protecting everyone inside.
Wow. This totally reorients how we have to look at the global financial architecture.
It really does.
Because the prevailing assumption has literally always been that all roads eventually lead back to Wall Street, right?
Yeah.
That the U.S. Treasury market is the undisputed center of gravity for global liquidity.
Always.
But the analysis we are dissecting today paints a picture of a world that is distinctly splitting into parallel tracks.
And that parallel system is no longer just theoretical, It is actively functioning right now.
The numbers prove it.
Exactly. On the equity side, Hong Kong has successfully utilized its unique position to become this heavily regulated, highly filtered epicenter for Chinese capital formation.
Right, letting them bypass the geopolitical risks of New York while still offering access to global dollars.
Yep. And then on the fixed income side, the mainland's unique combination of energy insulation and domestic economic weakness has turned its sovereign debt into the ultimate global inflation hedge.
And the billions of dollars being poured into concrete skyscrapers in Hong Kong by tech giants and massive investment banks, I mean, it proves that the infrastructure to support this parallel system is being bolted to the ground permanently.
It's physically manifesting.
You cannot simply monitor the S&P 500 and the U.S. 10-year yield and assume you have a pulse on the global economy anymore. The entire playbook has completely changed.
It really has. And honestly, understanding this structural shift leaves us with a critical, somewhat uncomfortable question to consider moving forward.
Oh, what's that?
Well, over the last year, the world's largest pools of capital have learned how to utilize the Chinese financial ecosystem as a reliable safe harbor during international crises and inflation shocks.
Right, they've tested it out.
And they are building the muscle memory to operate outside the Western financial system. So if a strictly domestic crisis were to hit the United States economy in the future, perhaps a severe localized recession or some sort of credit event, we have to wonder, will that massive pool of global capital ever fully migrate back to Wall Street, or is this new parallel system simply the permanent new reality?
That is exactly the kind of structural question that every investor needs to be weighing right now. Because if capital finds a new harbor that keeps it safe during the storm, it is very, very hard to convince it to sail back out into volatile waters just because of tradition. Well, we have covered incredibly complex ground today, from the mechanics of corporate redomiciling to the paradoxical strength of sovereign bonds in a weak economy. Thank you for walking through this structural shift with us. Don't forget to subscribe and hit that like button.